day, everyone. Thank you for taking time to watch our video presentation. Our group will present the candlestick charts, a vital tool in financial analysis and trading. Before we begin, allow me to acknowledge and introduce our team, Bong, Mona, Moy, Mao, and yours truly, Daphne, and we are the Fortune 500. Let's begin by exploring the fascinating history of candlestick charts. These charts originated in 17th century Japan, introduced by a visionary rice trader named Munihisa Huma. While trading in Osaka's Ujima rice market, Huma made a groundbreaking observation. Rice prices were not only influenced by supply and demand, but also by the emotions and psychology of traders. Recognizing this, he documented price movements in the rice market, creating a system that would later evolve into what we now know as candlestick charts, a cornerstone of modern financial analysis. Now, what is a candlestick chart? Now, from its rich history dating back centuries ago, the candlestick chart has evolved into a widely used financial tool for visualizing an asset's price movements over specific time frames, such as a day, hour, or minute. Each candlestick displays 4 key data points: the opening price, the closing price, the highest price, and lowest price. Candlestick charts provide a concise yet detailed view of an asset's price fluctuations, enabling analysts and traders to assess market trends, volatility, and sentiment with clarity. Now, what are the parts of the candlestick? Let's first tackle the real body, or also known as the candle body. It is the rectangular portion of the candlestick, which depicts it represents the price range between the opening price and the closing price for a specific time period. Now, it can be distinguished by its color and the length of its body. Now, a bullish candle or an indication of price increase has a color green or white. Meanwhile, a bearish candle or an indication of a price decrease has a color red or black. Now, a long body suggests a strong momentum. Meanwhile, a short body indicates limited price movement. Now, another part of the candlestick is the upper wick or the upper shadow, which represents the highest price an asset reaches during a specific time frame. So a long upper wick indicates a bearish sentiments. So it shows that while buyers push the price higher, sellers regain control. Meanwhile, the short upper wick depicts a limited upward movement. So by analyzing the length of the upper wick, we can gain insight into market sentiment, resistance levels, and potential price trends. Another part is the lower wick or lower shadow, which represents the lowest price an asset reached during the time frame. Now, a long lower wick suggests a bullish sentiment. Meanwhile, the short lower wick suggests limited seller momentum. By analyzing the length of the lower wick, we gain valuable insights into market sentiment, support levels, and potential reversals. So knowing all of this, what is now the importance of the candlestick chart? Now, candlestick charts are like a window into the world of financial markets. They provide traders, analysts, and investors with a straightforward view of how prices move. By using these charts, people can gather important information and make smarter decisions.
Now we're going to go over the different individual candlestick patterns. And in this part, we will be looking at how we can recognize or identify these patterns and what are the market implications of each pattern in trading. Let's go over them. A Marubozu. A Marubozu is a candlestick pattern that is one of the easiest to identify due to its simplicity and clear structure. It has a full body dominance and with no sticks, which means that the open and close price equals the high and the low price. This specific pattern reflects a strong market signal. It represents clear market sentiments, and that is strong buying pressure for a bullish Marubozu and a strong selling pressure for a bearish Marubozu. A spinning top. A spinning top is a candlestick pattern that is a short or a small body that's vertically centered between the long upper and lower wicks or shadows. The opening and closing prices are close together, and the wicks are relatively long, indicating significant price movements in both directions during the session. This pattern reflects the market lacks clear direction. It shows that neither the buyer nor the sellers have gained or gathered significant control during the trading session. There is uncertainty because the traders may be waiting for further signals before committing. The spinning top should be followed by subsequent candlesticks or other technical indicators to confirm the next market move. A doji. A doji is a candlestick pattern that is characterized by a very small or non-existent real body, where the opening and closing prices are nearly the same, identical, or very close. This specific pattern reflects market indecision, which means that the buyers and sellers are in a constant tug of war, resulting in no clear winner for these sessions. Remember, if a doji appears after a strong upward or downward trend, it could signal the weakening of the current trend and that there is a potential reversal. There are four types of doji. The first one is a standard doji. A standard doji indicates general indecision and appears in various market conditions. A dragonfly doji. It is represented by a long lower wick or shadow, but with no upper wick. It indicates rejection of lower prices and a potential bullish reversal in a downtrend. A gravestone doji. This is represented by a long upper wick or shadow, but with no lower wick. It suggests rejection of higher prices and a potential bearish reversal in uptrend. Long leg doji. It is represented by a long upper and lower wicks. It reflects extreme indecision and significant price movements in both directions before closing near the open.
Another set of individual candlestick patterns are the hammer, hanging man, and shooting star. Now, the hammer has a small real body near the top of the price range, and it has a long lower wick. The hammer is a bullish reversal candlestick pattern that often appears at the bottom of the downtrend. This suggests that selling pressure is weakening and buying interest is growing. Therefore, if you see a hammer during a downtrend, it could be a buy opportunity, especially if the next candlestick confirms the upward movement with a bullish close. Now, an example would be on March 2023, Tesla stock experienced a sharp decline over several trading sessions. So a hammer candlestick appeared on the daily chart at a key support level of $150. Now the candlestick had a long lower wick showing significant selling pressure during the session, but the stock closed near its opening price as buyers stepped in strongly. As you can see, on the following trading day, a large bullish candle confirmed the reversal. This indicated a potential buy opportunity for traders who anticipated a recovery in Tesla's stock price. Next is the hanging man. As you can see, it resembles a hammer, but a hanging man occurs after a rally. So the hanging man is a bearish reversal pattern that occurs at the top of an uptrend. Now, if a hanging man is confirmed by a bearish candle in the next session, it could signal a sell opportunity. So traders might exit their long positions or even consider short selling. So here's an example of a candlestick chart for Apple. In September 2023, the hanging man pattern is highlighted at the peak of the rally. So this pattern, followed by a bearish candle in the next session, signaled the start of a correction. Now, next is shooting star. So the shooting star has a small real body near the lower end of the trading range and has a long upper wick. Now, the shooting star is another bearish reversal pattern, but it forms at the peak of an uptrend. Now, this pattern shows that buyers tried to drive the price higher, but were overpowered by the sellers. This reversal signal often marks the potential beginning of the downtrend. So when a shooting star appears, it's a signal to sell or short sell, particularly if the next candlestick confirms with a bearish close. So here's a shooting star candlestick illustration using the Amazon stock price movements in August 2023. So the shooting star highlighted in blue, that was in August 10, marks the peak of the rally. So the long upper wick indicates that buyers initially pushed the prices higher, but sellers regained control, driving the price down by the close. So the following session is confirmed by the bearish reversal with a significant decline, leading to a temporary downtrend. So this pattern provided a clear sell opportunity for traders monitoring the market. So in summary, these individual candlestick patterns, Marubozu, spinning top, Doji, hammer, hanging man, and shooting star, are critical in understanding market sentiments. While Marubozu showcases decisive control by buyers or sellers, patterns like the hammer and shooting star point to potential reversal. So always confirm with subsequent candles before taking action.
Hi everyone. Earlier, we learned about the individual blended patterns. Now we move forward for a quick and insightful session on the blended candlesticks pattern. If you're a trader or investor looking to sharpen your market analysis, this is for you. Today, we'll focus on 4 key patterns: the engulfing, harami, dark cloud, and 3 black crows. So let's start. We start with the blended engulfing pattern. First up is the engulfing pattern. It's a classic reversal signal. When blended, this pattern shows a large candle that completely engulfs one or more previous candles. It shows a strong short-term predictive power using the open and low prices, but not the closest prices. Let's discuss further, starting with the bullish engulfing. It is a small bearish candlestick followed by a large bullish one, completely engulfing the previous day's range, and it forms after a downtrend where the buyers regain control, pushing the prices up. For example, imagine Ayala Land. It's a bullish engulfing pattern appear in its stock chart following its optimistic financial outlook for the future. Supported by strong earnings in 2023, the company has been expanding its projects, focusing on high-end developments. So what do we recommend you to do? Buy after bullish engulfing. The next engulfing pattern is bearish engulfing. It appears after an uptrend, showing that sellers are overpowering buyers. According to Hines et al. In 2021, bearish engulfing is a 2-candle pattern believed to forecast a price top, and consequently, prices are expected to fall. Let's take a look, for example, the DMCI holdings after a short rally. This signaled that sellers were overpowering buyers, pushing the stock lower. Despite the company having reported record high sales in its coal and nickel sectors, its stock price eventually fell. This was partly driven by the broader concerns about external market volatility and commodity price fluctuations. When you recognize this pattern, we recommend you to act fast and sell your shares. Take profits or prepare to short the market. Simple, right? Let's move on to the next pattern. The blended harami pattern. It literally means pregnant in Japanese, and this is a 2-candlestick pattern that shows indecision in the market. When blended, it represents a small candle inside the body of a larger one. So let's differentiate. First is the bullish harami. It is recognized when a large bearish candlestick is followed by a small bullish candlestick within its range. It indicates a weakening of the current trend and so signals a potential reversal to the upside after a downtrend. For example, the Jollibee Foods Corporation. After a series of declines earlier this year, this indicated that the selling pressure was easing, leading to a strong upward reversal. Jollibee stock showed a bullish reversal at a certain moments, such as when the company announced positive financial results. Despite some volatility, their recovery was driven by positive growth in global sales and strategic expansions. So what you do? You have to buy or probably wait for a confirmation of the reversal. If you wait, you must buy ASAP when the trend shows signs of reversing upwards, especially after a strong downtrend. We now move forward to bearish harami. It indicates the opposite, so a possible downtrend after an uptrend. According to Cohen in 2020, this pattern possesses genuine predictive power. Take, for example, San Miguel Corporation. It showed SMC might show after a rally where there is a small red candle within a large green one suggests an impending reversal. SMC stock showed signs of weakening when its stock dropped by over 1% during the weeks leading to December 2024. This coincided with a notable bearish shift in the broader market sentiment, where analysts flagged caution over its expected earnings growth. So what do we do after this? You have to sell or short. Sell or take profits when the trend shows signs of reversing downwards after an uptrend, or you might just want to tighten up your stop loss strategy. The third one is the blended dark cloud cover. So now, let's talk about it. It is actually a powerful bearish reversal pattern. When blended, this pattern forms when a green candle is followed by a red candle that opens above the previous close and closes below its midpoint. It shows that the sellers have gained control and the upward momentum is likely fading. Alanazi highlights that this pattern represents a potential reverse or a U-turn in the price when they occur and signals a potential bearish reversal after an uptrend. Honestly, I couldn't really find an example for this pattern, but I believe cryptocurrency markets are highly volatile, which makes technical patterns like the dark cloud cover. Traders use it to predict potential price corrections or reversals in popular coins such as Bitcoin or Ethereum. The pattern's formation, often followed by a drop in price, reflects changes in market sentiment from optimism to caution or bearishness. So our action, or what we should do, if you see this at the top of an uptrend, it's time to sell or prepare for a bearish move. Always confirm with volume or additional indicators when necessary. Lastly, we discussed about the three black crows, a strong bearish signal. When blended, this pattern appears as a single large one candle representing sustained selling pressure over multiple sessions. It typically shows up at the top of an uptrend, signaling the market is likely reversing downward. Mukansi in 2021 represented these patterns as a 3 consecutive bearish candlesticks with lower closes each day. Let's take, for example, SM. So SM Investments showed this pattern during a market correction last quarter. Although SM Investments reported growth in both net income and revenues for the first 9 months of 2024, there were areas of concern. For instance, its retail segment, while reporting overall growth, saw a decline in net income. This drop in profitability in the retail division, combined with the normalization of margins, could have contributed to investor caution. So our action for this pattern is, if you are holding a position, it's a good time to exit or prepare to short. This pattern is reliable, especially when accompanied by high volume. So to recap, we have engulfing patterns, the harami patterns, the dark cloud cover, and the three black crows. Blended candlestick patterns simplify market analysis, making it easier to understand price action. Always pair them with the other tools like volume or moving averages to strengthen your strategy.
This time, I'll be sharing to you another blended candlestick pattern, which is the three white soldiers. Now, the three white soldiers candlestick pattern is a bullish chart pattern that indicates a potential reversal of a downtrend in a price chart. Now, as you can see in its appearance, it's made up of three long green candlestick in a row that opens within the previous candle's body and closes higher than the previous candle's high. The candle should trend upwards like a staircase. So you can see it's on the green colored. Now, the meaning of this is that the pattern indicates that there's going to be a bear market has ended and the market sentiment has turned positive, or it's going to be a bull market that is coming. Now, the pattern is more reliable when it appears after a clear downtrend, the red ones, during a period of market consolidation or at a support level. Now, the candle should also have a short or no wick at all, which suggests that buyers controls the market. Long wicks indicates that the opposing power is still strong, making the patterns less reliable. Like I said, this three white soldier is the opposite of the three black crows that was discussed by Ms. Diano. Now, for action in this kind of market, it's going to be you have to buy stocks as the market is likely to continue uptrending. Now, an example of this one is during Carbird showed this pattern during their market order of their new facilities last quarter. Next is the morning or evening star blended pattern. So as you can see here, these are three consecutive bullish or morning star pattern and bearish candlesticks. It forms following a downward, the red ones, an upward trend for the evening star pattern, indicating a start of an upward or downward pattern of stocks. Now, this is the interpretation of this one is a reversal of a previous price trend. So from red to green and a green to red. The middle candle of this morning star captures a moment of market indecision where the bears begin to give way to the bulls. For the morning star, or the bulls giving way to the bears for the evening star pattern. The third candle confirms the reversal of the price and can mark a new uptrend for the morning star and downtrend for the evening star pattern. And the price action is nearing the support zone, or whether or not the relative strength indicator is showing that stock or commodity is oversold. Now, to take action for this one is for the bullish positioning on the morning star and the bearish positioning for the evening star pattern. Now, the classic example of this patterns is, of course, during the pandemic, CLI showed this one, an evening star, because of, again, style of the construction. And upon recovering from COVID, the stock started to move up, showing a morning star pattern.